perspective, just in terms of where we are currently and where we're going in the next few weeks, the 19th, Gemma emailed me and said that it's a religious holiday, so campus won't be open, there won't be any lectures happening on that day, so unfortunately we won't be having a class then. But what I am going to do is I'm going to do this assignment, because this is due due on the 21st of September. Okay, so next week, I think the date is the 15th or something. Let's check. 12th. Yeah, so next week is the 12th, so we'll still have a lecture next week. Okay, we're doing actually really well. And the reason for that is because they've shortened the course a little bit. It's only 9 learning units in total. Before it used to be 16, so it used to be a lot more. Some of the notes you don't actually need, so I want to refer to that now. 9 and 10 is additional. Okay, 9 was looking at inventory. You guys don't actually need it. Okay, that's additional information. It's more accounting that's not necessary. So 9 and 10 you could actually, if you want to, remove from your notes. It's not necessary to study it. Yeah, perpetual and periodic, not something that you are going to have to need for this module. So, but if you want to keep those notes, keep them. I mean, you never know. But as the module stands now in 2018, they've taken inventory out and they've taken property, plant, and equipment out. Okay, that used to be a hard section. So, sorry, let's try and get there we go. Okay, that they've taken out as well. Right, so 9 and 10 you can actually ignore. It's not something that you'll be examined on. Okay, and then there are some notes that I haven't looked at yet. Let's just go and look at them. 11 we did look at, that was the current liabilities. 12 we haven't discussed yet, but we will, because we do need to differentiate between a non-current and a current liability. It's short, so I will cover that with you. And then 13 was just a note about consolidating all the rules. That's kind of what we're doing now, because we're looking at applying the rules and drawing up the journals and tier accounts. Okay, looking at your module, the disclosure isn't a very important area that you need to worry about. Okay? In other words, drawing up financial statements. Before, it was a whole separate section. Okay, students had to draw up financial statements. Right, so if we do past papers, so I haven't seen that 2018 one yet, but when I look at it, it's probably going to have lots of tier accounts, lots of trust accounting stuff, because that tends to be the focus and preference in this particular module now compared to what it was before. Right, so 13 is just a consolidation note about bringing all the rules together. We'll still use this, but we'll just apply it to what they're requiring. 14 is what we discussed today, the difference between the law practice and the client. 15, that you can ignore. Before they used to test ratios, now they don't. That you can ignore. That's additional information that isn't required. And then the last one, 16, they used to test things relating to HR, relating to how to manage the business, and those types of things. I see they've actually given you some background information regarding correspondence, but that's different to what they used to give you here. Okay, so 16 again you can also ignore. It's additional. Before they used to give them around 10, 12 pages of theory that used to cover this. So how should you run a good law practice? What systems should you put in place? How do you interview and screen your employees? That type of thing. Okay, training, all of that stuff. Okay, it's background. It's background in terms of how the business operates from a practical point of view. Okay, from an accounting point of view, this wasn't accounting. Okay, this was totally just added as theory. It was never accounting. It was just addition information. Okay, it's addition information now. You don't even need it. They don't talk about it. Okay, so all I literally need to cover with you is this one. Okay, study unit 12. Then the notes are complete in terms of what we need from the notes. There might be notes that I'll create for you for the last few sections, depending on whether we need any or not. Looking at the last, okay, Learning Unit 6 is practical. Okay, I'm going to start with that this week. Learning Unit 7 is more of the trust stuff. Okay, but this is looking at transfers. Okay, so it's what we've discussed before the break, but just one step further. And then 8 is looking at trust investments, interest received, and bank charges. Okay, again, something separate relating to accounting, but focusing again on the whole idea of client money and the business money. Okay, so that's a big focus now. You've literally got, well, half of 4 was covering trusts. Okay, 7 is covering trusts, 8 is covering trusts, 9 is looking at correspondence, also covering trusts. Okay, so lots and lots and lots of trust accounting. Okay, so probably, yeah, I mean, it looks a lot. So I'll look at that ahead of time. Maybe I'll do something in that week where we don't have a lecture, and I'll see if I can put some notes together for those 3, Learning Unit 7, 8, and 9, depending on what the actual content looks at or deals with. It's quite a simple concept if you can understand the basics, which is the crux of it. Okay, law, practice, business, and then just treat it the way we treated it before the break. Okay, whose transaction? Whose books? Okay, is it affecting us or is it affecting the clients? Okay, we account for both, so we have the clients' inverted commas books in our records. Okay, but we don't show what they actually do on their side. It's just stuff that relates to us. Okay, so anything that goes through our business in relation to the clients. Okay, so that's kind of where we are. So today I'm going to, obviously, so we've covered 1, we've covered 2, we've covered 3, we've covered 4, we've covered 5. 6, we're going to look at today. We might be able to finish it time-wise. How are we doing? I think we're doing well. Yeah, we're doing well. We'll probably be able to complete it, and then at least that's another section. It's nothing new. Okay, it's just looking at T accounts relating to the different law-specific accounts that you can have in a specific question. Okay, but we'll look at those examples and I'll cover one with you. Okay, I do want to try to get to past papers in the last maybe 2 weeks so we can focus on the 2018 paper that I don't have a solution for. We can create one, and then the 2017. One of them I haven't done, so we'll do that one together, and then you'll have solutions for the others. Okay, that I can give you from previous classes. Okay, but that's kind of where we are. Okay, that's just perspective. So let's start with the notes, just to cover a little bit of theory, and then I'll go to chapter 6. Right, so the last bit of these notes, once we've covered these notes today, you can actually leave the notes at home. Okay, there's quite a bit. You can file it, put it away. You won't have to bring it with you. I'll maybe hand out notes in future if we need for those last 3 sections. Okay. Right, so let's just wrap up this section, which is looking at a non-current liability. Okay, we've spoken about current and non-current before. This focuses on a long-term liability. Okay, anything non-current is long-term. You also get non-current assets, and that's land and buildings, property, plant, and equipment. Okay, that was taken out from last year's FAC 1503 to this year. Okay, so they haven't really given you any assets to consider in terms of depreciation or anything like that. Okay, so that does help a lot. Okay, based on what we know, non-current is long-term. We're looking at the financial position. The financial position looks at 2 things, the assets and the liabilities. Okay, assets are bought using what form of finance? Long-term or short-term? Long-term. Right, if you're buying property, long-term liability, exactly. So the purpose or the reason why we have long-term liabilities is to help build capacity in the business. Okay, if we had to cover PPE, that would be something that I would mention there, capacity. Right, so that could apply to a law firm as well. A law firm can either rent out an office and share office space with a large company or corporate, right? Or they can buy their own building or create their own building, depending on how big they are. Okay, so capacity is looking at exactly that. how is capacity generated or financed? It's through long-term liabilities. Okay, so just remember to keep, so you wouldn't buy a house using your credit card, okay? Because the finance is wrong for the asset that you're buying, right? So long-term for long-term, short-term is short-term. Okay, you can use the credit card, okay, to rent a vehicle or to pay for a hotel, whatever the case is. Okay, because that's short-term, right? But long-term is long-term, short-term is short-term. Right, and that's what this is looking at. Question. Is it Neo? Okay, well, the reason why you wouldn't want to use the credit card is because the cost as well. Okay, so if you're taking out a loan and it's a non-current liability, so a bond or a mortgage or vehicle finance would be cheaper in terms of the rate that you would have to pay back in terms of interest. Okay, so you wouldn't pay as much on a home loan as you would on a credit card. Okay, the interest rate on a home loan would be close to prime. Okay, around 10.5, depending on your risk. The interest on a credit card would be 25 plus, okay, depending on your risk as well. Okay, so the thing is, you wouldn't want to pay too much interest. Okay, and obviously if you're paying off a building, that's a long-term asset, and that loan might be a few hundred million if it's a big company, like you're saying. So even a big company would still use the correct finance to buy the asset. Okay, it's not so much long-term with long-term, short-term with short-term. It's also the cost element of it. Okay, so the cost of taking out a loan would play an important factor in your decision-making when deciding on what to buy. Okay. Right, so if I'm looking at a liability, we know that a liability is what? An obligation. That's the most important thing to remember. If liabilities are greater than assets, are we in a good position? Definitely not. Right, so companies need to avoid becoming insolvent or bankrupt. Right, and this is looking at that whole idea of a financial position. Assets, I think I might even have covered this with you in the first week when we spoke about financial position. Assets, 1 million. Liabilities, 2 million. Good or bad position? Bad position. Why? Your liabilities exceed your assets. So there actually isn't any value here for the business. Okay, if the liabilities are greater than the assets, you could land up in that position where you're insolvent or bankrupt. Okay, companies cannot pay the outstanding debt. Okay, that's the worst case scenario. Right, will the company be considered going concern? Yes, if the company is going to continue to operate. Not a going concern is when they're going to go bankrupt. Right, that was something we looked at with the qualitative characteristics. Right, which liabilities are more risky? Well, it depends on costs. Right, so if we're looking at liabilities, the only liability you guys have seen is the creditors. Okay, so who is your creditor? Your client. Okay, from a law point of view. Okay, that would be a current liability, it wouldn't be a non-current liability. If we look at long-term loans or bonds or other, in terms of risk, risk is relative. Okay, you get high risk and you get low risk, it depends. So if I'm looking at a non-current liability, let's say buying a building for the office. Okay, so if we want to buy an office building for the law practice, are we going to have to take out a bond? Probably. Okay, let's say it's a really nice office and we're going to have to pay 20 million for it. That is going to be financed through a loan, and there's going to be a bond on that. Okay, so what would you have debited? You would have debited the building, and you would have credited the loan. Okay, same basics apply. It doesn't matter what loan it is, long-term, short-term. A loan is a loan is a liability. A liability increases on the credit. Okay, is that risky? Well, it's risky because now you've got to pay back 20 million. Right, and if the business isn't operating and it isn't generating income, it cannot pay off the installments. Okay, and that's a problem. Right, that's the one aspect of it. risky because of the quantity. Okay, so how much credit do you take out? Okay, the more credit you take out, the more risky it is. Okay, because there's more to pay back. It's relatively straightforward to understand. Okay. The other thing to consider is the interest on the loan, and that's a separate consideration. Okay, and I see they do test that later as well. In that one chapter here, interest received, trust investments. Okay, so even a trust, so you can invest your client's money in a separate account. It doesn't have to be transactional. It could be something that you could generate interest on. Okay, short-term interest, obviously, not long-term. But that's something we'll look at later. Interest received, interest paid, that type of thing. Okay. So we're looking at interest. There's going to be a rate that's going to be attached to that. Okay, so 10%, 20%, 30%, whatever the bank quotes. And if we're looking at risk, is the bank going to consider a loan for a building high risk or low risk? Correct. Why? Because if you don't pay back the 20 million rand loan, they can just come and take the building. Right. So from the bank's point of view, the risk is slightly lower. Why? There's something called collateral. Okay, collateral is having security against the loan. Okay, if your client doesn't pay you, is there any collateral? No. Okay, the client's not going to give you their car or their house as safekeeping, and if the client wins the case and they run away and they can't pay their fees, you get to keep their house and car. No. Okay, they're not going to do that. So there's no collateral there. All right, so when looking at charging your client interest, right, for them it'll be a liability. For us it'll be income. Okay, remember we looked at client control. Okay, that was actually in the previous example we looked at. Okay, the one example had debit the client control, credit the interest received. Okay, that was that general journal transaction. Okay, so you can charge your client interest, but you can also be charged interest. Okay, so here we're looking at the liability, just as a general discussion, okay, in terms of risk. Right, so the interest here that you would charge on a client's account, or as a client, in terms of they owing, you owing them, okay, they could charge you interest if they're your supplier. Then the interest rate would probably be higher, because can they come back and take anything? No. Okay, so the rates are normally higher, around 25%, maybe more, maybe a bit less, plus minus. Okay, so in terms of costs, the risk is higher, okay, because there's more interest to pay. There will be less in terms of the amount, but something to consider. Okay, would the bank view this as more risk or less risk? More risk. Why? Because there's no collateral. Before we could take something, now we can't. Okay, so that's just the general basic understanding relating to assets and liabilities and the liability side of it. Is there a better type of credit? No. Okay, long-term or short-term, it doesn't matter which one you're using. You just need to make sure you manage it so you don't get yourself in too much debt. Okay, and the same thing will apply to a company. Okay, so more risk, less risk. No collateral, collateral. Lower rates, higher rates. Okay, it's all what we see in reality. Okay. Let's see, is this important? Yeah, this is just looking at obligations. Okay, so remember you guys asked me about, I think it was, I forget what expense it was. And then I said, if it's payable, it's a liability. Okay, so water and light payable is a liability. Water and light is a expense. Okay, that's kind of what this is referring to. Obligations have to be met. Okay, if an obligation is not met, there's going to be a problem. Okay, it's called bad debts. When looking at the recognition or the measurement, so if I look at a liability, I'm going to look at the current value or the balance outstanding or the cost or the realizable amount. Okay, that's what we're looking at, because it's the liability that is going to be paid off. Okay, that would apply to your trust creditors account. Okay, so let's relate the law to it. Trust creditors. We know it's a liability. There's an obligation. Okay, if the obligations are not met, there's going to be a problem. Okay, so if you don't pay your trust creditors back, that's bad. Okay, it's their money, it's not yours. Right, so the main reason for having this is the obligation. Okay, there is always an obligation until it's paid back. Right, so you will never ever be able to claim the trust creditor's amount or balance as yours, because it won't be yours unless you've earned it, okay, or you've done something. Right, recognition and measurement, that's fine. We looked at that. Okay, debit the asset or the expense, credit the liability. It can be short-term or long-term. The same rule applies. And I think that's it. Well, borrowings and mortgages, this is just additional. This I don't think you need, but we can write that in. Financing assets. Okay, PPE is out, so mortgages and borrowing would generally be used to finance longer-term assets. Obviously, details are important, so when the company does take out these loans, they do need to look at the rates, the due dates, the amount, the security, and all of that. Okay, that's just part of the process. Okay, that's in the notes. This you don't have to worry about, and that was just an example from the textbook. Okay, all right, there's not too much there. The main thing is just trust creditor being liability, and liabilities are obligations that have to be paid off. Okay. Right, page 87. Learning Unit 6. Okay, so this is a little bit of consolidation. Why do I say that? Because I see this here. A trial balance. Okay, what does a trial balance do? It lists all of the different accounts. Okay, I see they are asking you about the creditor's ledger and the business's ledger. Okay, so that's a T account. Okay, we've drawn up a few T accounts where we did those very, very, very basic examples. Okay, now we need to look at it in more detail. I think we did some last week as well, if I remember correctly. Yes, we did. There was one. Okay, the VATs. I showed a debit and a credit. Was there any more? No, there wasn't. Week 2? No, that's bank recon. Week 1? No. Okay, yeah. So we haven't actually looked at it in too much detail. So here's a nice opportunity to look at it in a lot of detail. Okay, so general ledger. Let's put context to this. NB. How does a general ledger get created? What information does it require? Think back to the accounting cycle. You start with the transaction. Where must the transaction go? On a source document. Okay, once you've got those source documents, then we can put them in a journal. Okay, once we've got the journal, then we create the ledger. Correct. Okay, good. So NB, what is a ledger? An account for every specific element, inverted commas. Okay, so when I talk about the word account, I'm referring to a general ledger because the element is the high level. Right, so if we talk about assets, liabilities, income, expenses, capital, and drawings, those are the basic principles. Every single one of those accounts that you will see can meet the definition of one of those elements. Okay, so now we know that there is a trust creditor account. See, you can add that to your table. That's a new account. It's not a different element. It's just one of the elements. Okay, another one, client control. It's just another account. It's just another asset. That's all it is. Okay, fee income. It's just another income. It falls under that specific element. Okay, so when looking at a general ledger, every single one of those accounts are T accounts. And what does it look like? Let's draw it up. Okay, this is just basics. We'll go back to the textbook and I'll summarize what's there. And we'll do the examples actually. let's put a note here. Client control accounts. Okay, that's one account. You can have many different accounts. Okay, different tier accounts. The next one I'm going to call it trust creditors. Okay, then I'm going to call the last one fee income. Fee income. Notice they're all accounts, but they all meet the definition of one of the elements. Okay, so client control we just spoke about was an asset. So if this is an asset, where are you going to put the balance? Correct. So if I had to put a balance in, I would say balance brought down, let's put 100. Okay. In the client control account, am I going to earn money from the client? Hopefully. Okay, so let's say we're going to charge the client a fee. Okay, only charge the client, but not receive the payment. Okay, so if we charge the client a fee, are we earning income? Yes. So you would have debited the client, you would have credited the fee. Do you agree? Income increase. This is what you guys did right at the beginning in terms of the analysis. Of course. Okay, remember the receipt doesn't determine whether there's income or not. Okay, because that's the accrual. Okay, so remember, when we looked at this, just to answer your question in more detail, accrual basis, income is recognized when earned, expense is recognized when incurred. Yeah. Okay, you're looking at paid and received. That's the cash. That's the cash flow. All right, so can I earn income? Accrual. I think this is spelled wrong. Yeah. Okay. The accrual basis. So let's use an example here. Income is earned. Have I earned income? Yes. There's the earning of income. Your client is being charged a fee. Your client hasn't paid you. So what are we going to do? We're going to increase the assets and we're going to increase the income. Okay, remember we looked at contra accounts. Okay, the reason why we looked at contra accounts previously is because now we can reference things correctly. Okay, can I write down client control in client control? No. Okay, because the client control is being debited because of what accounts? The fee income, exactly. So in client control, you're debiting this, and in the fee income, you're crediting that. Okay, the fee income is income, so it can have a balance. It's possible. Okay, let's just say it's 10. Right, so if you are charging your client a fee, you are going to increase the client's, inverted commas, debtors account. So 30th or 31st of the first, fee income. That could have gone to the fees journal, FJ. Let's just say it's 20. So in fee income, I would reference that, and I would then show 31st of the first, client control. From the fees journal, that would have been the folio, 20. Right, and that's how you capture transactions in the ledger. Okay, so when I talk about a general ledger, I'm referring to lots and lots and lots and lots of these T accounts. Okay, the T account has a debit side, which is the left, and the credit side, which is the right. All the basics apply. Those 6 rules that you had for assets, liabilities, income, expenses, capital, and drawings, all of that still applies. Okay, the analysis that you did in chapter 1, 2, 3, okay, that still applies. If you get the working, it's easy to do the posting. And that's why it's so important to understand what the transaction is saying. Right, so that's what we're going to try to do. We're going to try analyze the transaction and post it appropriately, correctly. Right, just to talk to the account that we wrote down here, trust creditors. What is it? It's a liability from the business point of view. So a balance would be on the credit side. Why? Liabilities have a balance on the credit side. Let's just say it's 30. Okay, so it doesn't matter what account you're dealing with. All accounts have to be one of the 6 elements. Okay, that's everything. Right, so the better you know that, the easier this is. Okay, so let's go back and let's look at the textbook. Alright, balancing the ledger accounts. This is a process and they've given you steps here. That's really good. Before they never gave it to the students, they had to practice it. So let's balance an account. Okay, I'm going to use the bank recon because we've looked at something already there. Okay, recap the bank recon. Only the balancing though of the accounts. Okay, I'll give you one to do, I'll do one with you. Okay, so when we did a bank recon, obviously you had a bank account. That was a general ledger. Okay, that's general ledger. Right, so let's assume that bank started with a credit balance, so an unfavorable balance. If bank has an unfavorable bank balance, it's going to be a credit. Right, what transactions or what journals will affect bank? The CRJ will affect the bank account. Do you agree? Okay, in your notes we said always debit the bank. Why? Because you're receiving money. Okay, it doesn't matter where you receive the money from. CRJ. If the owner gives capital, will the bank go up? Yes. If the client pays cash because you sold them something, will the bank go up? Yes. If the bank gives you interest on your favorable bank balance, will your bank go up? Yes. Okay, so all of those could be receipts. So if I have a receipt here, 31st of the 1st, total receipts. They would have come from the cash receipts journal. Let's say it was 100. Okay, do we only receive? No. We're also going to pay. So what we covered before, the cash payments journal will always affect the bank. How? Negatively. Okay, decrease. I forgot to add a word there, decrease. Affect the bank, positively increase. Okay, so always debit the bank, always credit the bank. There's the two. Okay, that's revision. Right, let's put the one in green. And the one in red. Okay, so this is a receipt that increases the bank account. This is a payment that would decrease the bank account. So 31st of the 1st, total payments, CPJ, and that's why when you did a bank recon, you wrote down total payments on the credit side. It's because you're paying and you're reducing the bank. Right, let's say that amount was 60. Right, so what the textbook is talking about here, balancing the ledger account. You've actually done it already. Right, so if you want to study it and read how to do it, you can look at that. Okay, how do I do it? I check for the bigger side. Which side is bigger here, guys? Is 100 bigger than 70? Yes, so I write down the bigger total. Okay, this is balancing the accounts. Okay, so if I look at the debit side, I had 100. If I look at the credit side, I had 10 and I had 60. Okay, 10 and 60 gives me 70. 70 on the right is less than 100 on the left. So I write down 100 on both sides. Okay, now if you look at it, do you have 100 on the left? Yes. Okay, 100 here, 100 there. Perfect. Do I have 100 on the right? No. Okay, I've only got 70. That's why you balance the account. So how do I balance the account? you find the difference. Balance carried down, 30, and then bring down for the next month. Balance brought down, 30. Okay, that's the balancing. So the textbook is describing that process. They're describing this, balancing the account. That's how you do it. Okay, it's as simple as that. Okay, I'm going to give you one to do. Okay, let's say the receipts are 200, the payments are 260. Okay, opening balance favorable 40. Okay, can you balance the account? Okay, you do the rest. Right, so that's the information that you'll be given. Okay, you'll need that. Obviously, the receipts would have come from the CRJ. The payments would have come from the CPJ. That I won't draw up here, but I'll just give it to you as is. Okay, would you be able to balance this account? Okay, hopefully. Do what we did previously. Try it. Put in the opening balance and then balance the accounts. obviously the first step is to record that. The question would have said something about an opening balance, and if it's favorable, it would have gone here. Right, then you would have looked at the cash receipts journal and you would have pulled the total through to your T account. You would have looked at your CPJ and you would have pulled the total through to your T account. Okay, next step is to check which side's bigger. So on this side, I've got a debit of 40 with a debit of 200. 240 is on the debit side. What do I have on the credit side? 260. Which side is bigger? This side is bigger in this example. Right, so you write down the 260 on both sides, and then what do? You balance off. Right, so now I've got 260 there, everything's good. I don't have 260 here, I'm missing something. Right, so the missing amount is the 20, and that's the amount that you carry down. Okay, it must be carried down onto the credit side. Okay, so the balance that you have at the end must be here. Because if you think about it logically, is the bank balance still favorable? No. Now it's unfavorable. Because you started with 40 Rand in the bank, you received 200, you paid 260, now you're owing the bank 220. Okay, that's just logic, basic logic. Okay, just going back and thinking about it. Okay. Right, and that's what you would have done. That's balancing the accounts. Right, we've looked at it before, we've looked at it now in detail. So a little bit of revision, I guess, but it's always good to reinforce the basics. Okay, here's one. Here they've shown you business of the bank account. Okay, they've shown the capital. Obviously, that must have been a contribution. Wages, balance, bank, and then they've balanced it. Okay, we'll look at activities, ones that haven't been done yet, and then we'll discuss those. Okay, let's see if there's anything else here that we need to look at. Okay, client ledger, business creditors ledger, and trust creditors ledger. Right, so earlier you guys asked me about TCL. There's TCL. TCL. Business creditors ledger, BCL. Creditors ledger, clients ledger, CL. Okay, so what is the purpose of this? It's to reference things correctly. Right, so just to add a note here, NB. Right, the CL, comma, the BCL, comma, the TCL is used as a reference to identify different client accounts. Okay, it's a form of control. We can put the word control there. Right, that's the reason why you're identifying three separate ledgers. Okay, so when I talk about a general ledger, what am I referring to? I'm referring to all the T accounts. Okay, all the T accounts. Right, but now I'm not referring to a general ledger. I'm referring to a trust creditors ledger, or a client's ledger, or a trust creditors ledger. Alright, so do you agree these ledgers are more specific? What do you think we're going to see in a client's ledger? All the clients. What are we going to see in a business creditors ledger? All the business's creditors. What am I going to see in the trust creditors ledger? All the trust creditors. Okay, so it's just a grouping of the same T accounts. That's what it does. So just to summarize this, these ledgers group the same, inverted commas, people. Okay, so e.g., all the clients will be in the trust creditors ledger. Okay, maybe I should be a little bit more specific here. All the clients, brackets, giving the law practice money. Right, will be in the trust creditors ledger. Okay, because a trust creditor is exactly that. It's a client who has given you money. Do you guys all agree? Okay, so all of those clients that have given you money will all be in a trust creditors ledger. That's all it is. It's a control mechanism. It's to keep all the clients together. It's to keep all the business creditors together. So what would a business creditor be? Yes, the supplier that the business owes. Okay, so we owe them. Liability. Trust creditor, we can write it down, we've seen it already, but let's do it again. Trust creditor, clients who we owe them money, who owe them their money. Let's be more specific. Okay, it's their money that we owe them. Yes. Okay, well, in the trust bank accounts. Yes, so you are my attorney and I deposit money with you. I am your trust creditor. Makes sense? Of course. Okay, you're the lawyer. Okay, does that make sense? Okay, just think about it practically. Okay, it's actually quite easy if you put yourself in the situation. Okay, you guys are all like law practitioners, okay, law experts, lawyers, advocates, attorneys, whatever you're aspiring to become. Okay, so just take it from that point of view. Okay, if you take money from your clients, they're your trust creditor. Okay. Right, and then you can read through this if you want to. That's summarizing that bit. Okay, let's carry on. Trial balance, we've seen that before. You actually had a note about it, so that's fine. Okay, here's an example. Let's do this one. Okay, but let's do this one correctly in terms of the correct exam technique. Alright, so this could have been an exam question, it could have been an assignment question, it doesn't matter. The thing is, it's something that we need to approach. Okay, what is this question asking for? So this is the steps. Right, the reason why I want to try build on your exam technique is we're getting closer to the exams. Okay, so exam technique. Okay, this I'll discuss when I actually do the past papers with you. I'll show you how to do them. Okay. First step, required, always. Okay, before that is more important because before you had to draw up your own answer sheets. Now they give it to you, so it's a bit better. Right, so I look at this and I see, what do they want me to do? Let's scroll further down. This one's quite a long one. Okay, here, part A. Record the above transactions in the journals. Okay, there's the journals. Right, that we won't do. We're not going to waste time. Okay, the journals are there. Okay, I'm going to put the stuff that we need. Okay, the workings. Right, so how do we get from the question to the answer? So the journals, we can just look at what they've got and we can transfer it to this bit. Okay, that's what we actually want to focus on in this particular chapter. But let's apply the basics, okay? Right, so I'm still going to do exactly what I did in the past, okay? Step 2, draw up the templates, okay, which might not apply to you as much now because they give that to you, and then I'll obviously need the journals. Okay, then step 3 is to analyze one by one, post one by one, and then you can't go wrong. Okay, you'll see what I mean by that when we do it now. Okay, so I've looked at the question, I can see I'm doing what? Journals and general ledger. Okay, so step number 1 would have been looking at that. I would have drawn up the journals. Okay, I'm not going to draw up the journals, I'm going to just draw up the ledgers, okay, the T accounts. Okay, step number 2 is to analyze one by one by one. Okay, so don't worry about all of them, just look at each one. Okay, it's impossible to do this whole thing in one go. Right, so if I just look at number 1, Pay office rent for August to N per check. Good. Okay, you can write business CPJ there. Okay, I'm going to do one step better. What page is this on?
Page
90. Thanks. Okay, example number? Thanks, 6.1. Okay, so these would be my workings. This I wouldn't even do on the actual answer sheet. I would just do it on the question paper. Okay, if I need it. Okay, if you're confident in your ability to get the debit and credit, there's no need to do this. Okay, I'm just doing this because we've always done it. Okay, this actually wastes time, but it's worthwhile now because you need it. Okay, if you get more comfortable, don't do it. It wastes time. Okay, just apply it, but we'll still do it. Pay office rent per check. The word per check is important. This is a business expense. So you would have debited the rent. You would have credited the bank. It would have gone to the business CPJ. That's the key. Sure. Yes, you do. They're a VAT vendor. Are they a VAT vendor? Yes, there we go. Okay, so let's revise that as well. Okay, so we've covered that. Let's recap that. Will you have VAT on rent? Yes, it's called input-output. Input VAT, correct. Remember, you're paying for something coming in. Okay, input VAT. Input VAT is not an expense, it's an asset. Asset increase, rent, expense, increase. Bank, asset, decrease. Right, that's the working. Okay, that you can think about, and then you can record that in the journal. Right, so if I go to the journal, let's just show you because this is what I mean, line by line by line. Because you would have drawn up the columns, then when you would have found your business CPJ there, and then you would have recorded that in. See that? Is that okay? Right. Okay, so I want to do the workings with you guys. At least then you've got that. Maybe just something additional as well. We've looked at the workings for this is VAT inclusive, do you agree? 3990. So that would have been what I paid, do you agree? I would have paid 3990. That would have been the total that would have come out of my bank account. Okay? Of that amount, a portion is rent and a portion is VAT. Okay, so how do I get the VAT portion? 3990 times 100 divided by, times 14. Let's do the VAT exclusive. I'll move this up. Divided by 114. Okay, you guys are still using 114, hey? Okay, so this times 100 divided by 114 gives me that. Once I've got that, I can take this amount and I can subtract this, and I get the difference. Okay. You can do that however you want. If you wanted to work out the VAT first, then you would have shown this. Times 14 over 114. Okay. But that's the working that you would have gotten. Right. All you need to do the answer is that working. Okay, then you can go put that in the nice columns. You can find the right column for rent. You can find the right column for VAT. You can find the right column for bank. And then you're going to have something that looks like this. Like that. See that? Okay, they haven't even used many columns here. They've just used one, sundry. Okay, so when I gave you those templates, okay, I had the little sundry at the end. Okay, you would have used that last end column. You would have put the details for whatever it was. Okay. Sundry is just for everything. Sundry actually means other. Okay, but they don't, see, they've made it easier. Before they would have given you different columns. Okay, now they just want you to put everything in sundry, which is fine. Okay, but yeah, just follow what they've taught you, what they've covered in the study guide. Okay. Right, so we've done the first one. The next one, pay the increase in the deposit for the office rent to N per check. Pay the increase in the deposit. Okay, so that means we've paid a deposit to the landlord. Okay, so business CPJ, this was per check, yes. Okay, does a deposit have VAT? No. Okay, there's no VAT on a deposit. So debit the rent deposits. Okay, see, there's more. Now we're looking at other types of accounts. That account is still an asset though. Why is it an asset? It's a resource. If you pay a deposit for rent, can you get the deposit back? Yes, you can. It's a deposit. No VAT here. No VAT on a deposit. 4,000. Okay, that's workings. Right, once you've got that working, where is that going to go? Business CPJ. Let's check if it's there. There's it. Yes. It's there and it's exactly the same. Okay, right. So I'm not going to always refer back to the answers. You guys can check this later on. We'll actually look at it later on when we do the post into the ledger. Right, I'm just going to carry on because it's going to be jumping around too much up and down. So I'm just going to stick on one page, on this page. Okay, so we've done that one. Okay, next one. Levy fees for services to L and received payment in cash. Okay, they've even given you that receipt number. Okay, so you've received the payment, and that was for a fee for services. So this is going to go to the CPJ, a CRJ. Okay, business CRJ. Okay, you would have debited the bank because this was cash. This was for services rendered. How would you services rendered? Levy fees for services rendered. Yeah, how would you services rendered? I don't think they'll mind. Do they? Okay, well, maybe they do. But yeah, so debit the bank, credit services rendered. Yeah, of course there's. Okay, when I render a service, do I have to collect 15% or 14% for SARS? Yes. Okay. Yeah, there's your working. Right, let's recap this. The VAT calculation. Okay, so that 19,152, where is that going to go? Is that going to go here, here, or there? Correct. The 19,152 is going to go here because when the client pays you, they pay you the VAT inclusive. They pay you everything. Right, you split out what's yours and what belongs to SARS. Right, so I'm going to work out the services rendered bit because that's the exclusive. Once I get the exclusive, I subtract to get the difference, and then I've got the answer. Okay, so here I'm going to show the working. 19,152 times 100 divided by 114, close brackets. If you're using 15%, you would use 115. Okay, but they still want you to use the old rate, which is fine. Just remember that would be the answer then. Okay, this minus that gives you the VAT, and that's it. See, there's your working. Now I can take that and I can put that into the right journal. Find the column, write it in, write in the amounts. See, that's everything. Okay, even if I asked you to do an accounting equation, you could do that. Okay, then you look for the right column and then the minus or the plus. Okay, so application isn't that important, okay, because it can change. This won't change. Okay, you either understand what this transaction is saying or you don't. Okay, that's the hardest part, is do you understand what that is describing? Is it describing a receipt or a payment? Is it describing something for the client or for the business? Okay, that's the challenge that you guys are going to have in terms of answering questions in the exam or in the assignments. Okay. Right, let's do another one. Purchased postage from petty cash. If I'm buying and I'm using petty cash, it's going to go to the petty cash journal. Okay, so PCJ, the petty cash will go down, so credit petty cash, bracket asset decrease. Okay, what did I pay for? Postage. So debit postage, expense increase. There will be VAT on postage. It's a business expense, you'll be able to claim it. Right, so see, there's your working. That's what we did right at the beginning, first week. Okay, because it's important. As soon as I've got that, then I can post whatever I want to. Journal, ledger, it's the same thing. Right, let's work out the amount just to revise the calculation. $399. $399 would be the total that I would have paid. That's the cash that I would have given to the post office. 399 times 100 divided by 114 gives me 350. Input VAT is the difference, this minus that. Okay, I will email this to you guys, so you will get this. So please don't feel like you have to write down like every single thing. Okay, you can if you want to, but rather understand what's happening. That's more important. Okay, because this you can just, if you really want to print it out later, and just add it to your notes. Okay. Debit Rogers with fees in respect of a third-party case. Now we've got something different, something that we looked at today. Client fees journal. Why? Has the client paid you? No, you're just charging his account with the fee. Okay, so debit R, what are we going to do? Fees journal, FJ. Debit the client control, credit the fee. Income increase. Client control would be seen as a asset. Would there be VAT here? Yes. Which one? Correct. Output, because it's going to be given to SARS. Right, what was the amount? 1254. 1254 is what the client owes us. 1254. Split out the fee. Take out the VAT. Get the VAT exclusive. There's the one figure. Minus gets the VAT. There's the VAT. Okay, so that's for the fees journal. Let's go and check that one. Okay, let's see. Where's the fees journal? Business cash receipts. Trust cash receipts. There's it. I went past it. There's it there. Okay. Fees journal. This is it. There's it there. Yeah. Okay, I see they've also included the first one there as well. Okay, for the services rendered in the fees journal. Okay, to me that's not a fee. Well, actually it could be. It could be a fee actually, because let's go back and read it. Levies fees for services rendered and receive payment in cash. Receipt. Okay, so they've captured the first part. They've captured this as an amount that's outstanding, and captured the receipt as an amount that's received. Okay, you could do it twice. It wouldn't make a difference to your records. Okay, because you're raising a debtor and then you're paying them off immediately. Okay, why you would do that? That's a little bit silly. Okay, the net effect will still be the same. Okay, I would just show one account like that. One amount in the actual cash receipts journal for the receipts. Okay, as we did it there. Okay. Right, I'm just going to do 2 more transactions. 7, pay for advertisements of the firm by check. 529. Right, what is that looking at? Business expense, 100% good. That's the key. Once you know it's by check, you know it's going to be a CPJ. It's for the business, so business CPJ. Okay, business CPJ, let's take that one. Will there be VAT here? Yes, there will, because this is advertising. Input VAT again, just change that to advertising, and then we've got the working. There's my working. Okay, how much was this for? Let's check. 228. Okay, that's a nice simple one. So it'll be 228 and 228. There's the splits. And there's the working. Okay, then you find the right columns, you put all of it in. Okay, last one. The rest I want to give you guys as homework, just to do workings for it. Okay, so for these, the rest here, if if you guys can try do the workings for the actual answers to see if you'd be able to get to the same answer. Okay. I'll do it, and then we can check it, and then we'll discuss the ledger transferring amounts through to it next week. Okay. Right, so number 10, Y instructs T to issue a summons against his wife for divorce and pays a deposit in this regard. Okay, remember, we need to look at the business's point of view. We are Truta. Okay, that's what we're looking at. Okay, we're the business. Right, so if you're looking at this, Y instructs us to issue a summons against his wife, and they pay us a deposit. See, now it's easy, right? Okay, it was actually a giveaway because of this. Trust receipt. Okay, it doesn't always have to be that easy. Okay, if they gave you just the instructions, then you would have gotten this. Trust CRJ. Okay, you would have debited the bank, the trust of the bank, trust bank, bank trust. Okay, trust bank. You would have credited the trust creditors liability increase. Would there be VAT here? No. Be careful. Yeah, be careful. Okay, no VAT when a client deposits money with the law practice. Okay, there will never be VAT there. Okay. It's just giving the business a resource. Okay, that was for how much? 4, 5, 6. Later on, if that money is used to do something, if it was a fee, okay, let's say you're going to then debit his account because of fee, then you would take out VAT. Okay, they're just giving you money, right, giving you 4, 5, 6. Okay, let's check that one as well. Let's go back down. Where are we looking at? Trust. This is business. There's the trust receipt. There we go. There's the one. Okay. Notice no VAT. You'll never have VAT. Okay. Right. You think you guys can do the rest? Try it. See how it goes. Okay. See if you can get the workings. Remember, the hardest part with this is the understanding, the interpretation. Right. So if you can take the rest, 11 to 31, and if you can identify, is this our transaction or the business or the client's? Is this our in terms of the business, or is this the client's? Okay, and where would I put it? What journal? Okay, do that before you look at the solution. Okay, because that's how you practice. Remember, accounting is a practice subject. You can cram all your other subjects a week before the exam, and that's fine. You can still pass. Okay, with this one, you need to try practice week by week by week by week. Okay, because it gets easier with practice. I'm sure, like now, you guys are good at doing this. Okay, before it was challenging. Okay, because this is the 4th week we've been doing that, so it gets easier. Okay, so please don't leave everything to the last minute for this subject. Okay, if you could just do a little bit every week, it makes a big difference.